Hi everyone, this video is how to actually make a posting on your forward contracts, and my main goal here is to show that this is simple and you can do it yourself. Okay, let's start from the input information that you have to have if you purchased your forward contracts. You have to have mark-to-market report on a monthly basis or on whatever basis that you agree with your broker. So, input. MTM report, mark-to-market report. In this report, your broker actually tells you what is your asset or liability from their perspective. So he tells you how much will it cost for you to close the contract. It's not kind of precise valuation, but it gives you an estimate. And it's not precise because of bid-ask spread, because of the timing, I mean, the rate changes every half a minute, every 30 seconds. So that means, and especially that then the mark-to-market report is done at the end of the day, that means the timing is already gone, and if you were about to close your forward contracts, the terms will be different. But it doesn't matter. I mean, for the accounting purposes, only the end of day of your reporting date matters. Not only like that. You can use a couple of assumptions. It's not exactly the end of the day. You might use some other rate, but you have to have documentation in place to show that this rate is reasonable and your approach is reasonable. Okay, let's move on. You have your mark-to-market report, and in that mark-to-market report, you have some values. And depending on the sign, if it's minus, it's liability. If it's plus, that should be an asset. Okay, what you should do next? A couple of things here that I'm personally checking. I'm checking if the mark-to-market report is good, and to check the quality of mark-to-market report. I'm recalculating the position myself, and I do this roughly by exploring interest rate differential technique. So I take 1 year contract, I have forward rate on that contract from the mark-to-market report. So I know it. For example, it's 1.2. And by having inputs, and they're available online and free of charge, you can calculate what's your forward rate according to market data. So you have your spot, you multiply spot by 1 plus rate in USD and by 1 plus rate in Euro. If you speak about Euro to USD exchange rate, I will drop a link where you can find this information. It's really simple, and this is for auditors. I'm checking this rate with the rate provided here. And I'm showing that the difference here is immaterial. Because auditors might argue that, hey, how do you know that this is true and fair estimate of your asset liability? And here I'm showing, yeah, it's true. I've checked it. Okay, that's basically it. Oh, no, one more point. Your mark-to-market report normally shows present value of your asset and liability without credit spread. And that means that your broker discounted the future value by risk-free rate. Normally this is SOFR. Secured overnight rate in USD, in United States dollars, if we speak about USD. Question here, how to implement your credit spread to have a real rate as a discount rate. It's easy math, actually. I will show you. It's a couple of seconds. So what is your current, your value, this value, your asset liability equals value future discounted by 1 plus SOFR. Let's assume it's 1 year, just for the sake of simplicity. So what is, and you need to add a rate, credit, risk adjustment. You need to add it somehow here. Okay. It's easy to do. Your rate so your future value might be calculated as your present value multiplied by 1 plus SOFR. This is from your mark-to-market report. So mark-to-market report, you can obtain value future by multiplying present by 1 plus SOFR. Okay, what do you need to have? This is what you have, that's what you need to have. You need to have your present value to be calculated as value future divided by 1 plus SOFR plus credit rate adjustment. So your premium for the risk. You have this value, you know it. You know SOFR. It's publicly available information. And you just to have to know what is your future value. And that's simple. You already have it. Here, your future value, you put it on the top. So it's value present multiplied by 1 plus SOFR and divided by 1 plus SOFR plus your credit spread. Once more again, just to wrap it up, you have your value in the report. It's separate column. This value is the present value of your asset or liability, but it's discounted by SOFR, risk-free rate. You have to have it discounted by your rate, and your rate normally means the rate at which you can borrow money at the market. So you are paying some kind of premium. To have it equal to your real rate, you take that value here, multiply by this and divide by this. Okay, I will put link where to get SOFR, and for the credit risk adjustment I will dedicate special video because it's a separate topic. It's also simple. You might already have that rate. If you have your rate of borrowing, you just put your rate of borrowing here with instead of SOFR plus risk adjustment, and that's it. If you don't know it, I will dedicate special video how to calculate it using market data and some internal information, and prepare documentation for auditors. Okay, thank you. It was Sergey Zotov. See you soon.